Good afternoon. It's Jeff Christian. It's Monday, the 27th of July, late in the afternoon here, about 4:30. The price of gold started the week by jumping up to $1,940, $41, which is a record high price for the price of gold. We had issued a trade recommendation on Friday when the price was about $1,893. And we said, look, we've been saying that the price could spike up to $1,920. And we think that that could happen over the next few days. There are a variety of economic and political issues that are going on. There's a great deal of uncertainty in the United States economically, in terms of public health and in terms of politics. It's a very tenuous time. Brexit is still a problem elsewhere. There were problems in China and Russia and around the world. There are a lot of reasons for people to want to own gold. Additionally, August is an active COMEX traded month, and we had an enormous amount of gold open interest in the August contract. Anybody who was short that August contract, they have a choice of three things. They could deliver into it if they have physical gold. They can buy the short contracts back and liquidate them, or they can buy the short contracts back and sell forward. Typically what happens, because of the nature of the financial transactions behind those short positions, is they roll forward. And we've been watching the August open interest roll forward. As to the close of business on Thursday, you had about 27 million ounces of open interest in the December contract, much of which had been bought back in the August contract and then sold forward in December. And that was one of the factors that had driven the price of gold from $1,780 at the beginning of July to $1,893 last Friday. You still had 22.7 million ounces of open interest at the beginning of Friday. You saw a lot of that happening. The numbers come out today, and it's down to 19 million ounces, which means another 3 million ounces of August contracts were bought last Friday. I'm sure even more were bought today. The first delivery day for the August contract is this coming Friday, the 31st of July, which coincides with a number of things, including the end of some of the support work that's been going on with the U.S. government giving out an incredible $600 a week supplemental unemployment. So the 31st of July is going to be an important day, and it's going to be an important day with the August COMEX contract too. We think that the price will be very volatile this week as you look at that last 19 million ounces being unwound. It'll be interesting to see how much was rolled forward today when we get the numbers on Tuesday. Probably a lot of it was. In this environment, the gold price could rise a lot further over the next 4 trading days. And at some point, the gold price should be expected to fall, and at this point, fall significantly. I mean, if it rose $40 today, $50 at one point, it could easily fall $50 when the August congestion is behind the market. So our trade recommendation that we issued today, because our 1920 objective from Friday's trade recommendation was hit, our trade recommendation today was probably to stand aside, because you have to be a really facile trader to trade over the next 4 days. At some point, the wool will be behind the market, and the price is going to come off. You could try to be bold and stay long or go long and take some more profits if the price rises further over the next 4 trading days. But our view was that most investors want to be cautious. You could lock in, at this point, you could lock in $130 of profits if you bought prior to the beginning of July. There's a lot of profits there, and it might make sense to take some profits and stand aside and wait for the price to go down before you go long again. So that was sort of our view. Additionally, we issued a market commentary today, which is available in various places, including our website, cpmgroup.com, and that was on gold hedging. And we pointed out that gold producers could lock in $1,600 an ounce gold for the next year at current market conditions and give up $10 of the upside. Now, 1,600 sounds paltry compared to the 1930 that you're here today, but if you look at a price chart, the gold price was far below $1,500 from 2013 through the middle of last year. And it's only since last July that the prices started to rise. So locking in a minimum price of $1,600 and giving up only $10 of the upside for that insurance actually is a very attractive way to guarantee a minimum cash flow in an extremely volatile market. That's it for today. I think we'll probably be doing more of this over the course of this week because we think that the world and the gold market are going to be pretty hectic. And who knows, maybe we'll even do something about silver. Thank you.